Welcome to the deep dive. We are jumping straight into the fiscal first quarter results for Kura Sushi USA. It's a really highly watched name in the consumer discretionary space. And we're going right into the company's commentary because, honestly, the immediate market reaction was a major head scratcher.
It really was a classic good news, bad news report. And the market, well, it clearly decided bad news was louder. So our mission today is to move beyond that initial volatility. We need to synthesize what management is actually saying.
Right.
We need to figure out which parts of their growth strategy are working and, more importantly, drill down into what's slamming their profitability.
Okay, so let's unpack this. The results snapshot. Let's start with the top line because the revenue story is, well, it's stellar.
Absolutely stellar. Kura brought in $73.5 million.
Which beat consensus by about $500,000, right?
It did, and it represents really robust 14.0% year-over-year growth. So the expansion engine is definitely firing on all cylinders.
The growth is intact.
Undeniably. But here's where it gets interesting. That revenue beat was just completely overshadowed by a huge miss on the bottom line.
The profitability.
Exactly. GAAP EPS landed at a loss of negative $1.25 per share.
That is a huge miss. The street was only expecting a loss of, what, 9 cents?
9 cents. So for you, the listener, when we talk about GAAP EPS, that's the final official measure of profitability after everything is counted.
All the costs.
And that miss, that dramatic miss provides the entire context for why the stock was soft after the call. Investors are focused on the path to profit.
Okay, so revenue's up because they're opening new stores.
Yeah.
But the profit miss points straight to the efficiency of the existing ones.
Precisely. You have to look at the comp line and the cost structure. That's where you find the fault line.
And the first red flag was comparable sales.
It was. Comps were negative 2.5% year over year for the quarter.
And that was driven entirely by traffic declines, I saw.
Entirely. Traffic was down 2.5%. Their pricing and their mix were basically flat. So, when you have negative traffic and flat pricing, that immediately translates into margin pressure. You lose that sales leverage.
And that margin erosion is what spooked everyone. So let's get into the profitability breakdown, those key metrics.
The big one is restaurant level operating profit margin, or RLOPM.
RLOPM, right.
That margin compressed significantly. It fell all the way to 15.1%.
From what?
From 18.2% in the same quarter last year. That's a 310 basis point drop.
And just for a quick clarity check, when we say basis points, 310 basis points is just a 3.1 percentage point drop in that profit margin.
Exactly. And that drop is what drove adjusted EBITDA down from $3.6 million to just $2.4 million. This is the core financial issue. And when you dig in, the problem becomes very, very specific. There's one giant headwind that management just kept citing over and over.
The tariff trap.
The tariff trap, yes. This is critical for any company relying on imported specialty ingredients, which for Kura is everything.
So how did those costs actually show up?
Well, food and beverage costs rose to 29.9% of sales. That's up 90 basis points year over year.
And management was clear this was all tariffs.
Squarely and specifically, they quantified the drag for the whole year, saying tariffs alone, just tariffs, represent a massive 200 basis point impact on their total COGS.
200 basis points, so 2 full percentage points of extra cost just from tariffs. That is a huge structural headwind.
It's massive pressure. And it's not just the fish. The tariffs are also hitting their other operating costs line.
You mean the little prizes?
The little prizes, the Bakura Pun Capsule Machine giveaways, those are imported too. And they add another 40 to 50 basis points of pressure to that other cost line. So it's hitting them from multiple angles.
So I have to ask the skeptical question then.
Yeah.
They're still promising that RLOPM will recover to about 18% for the full year.
Right.
With a 200 basis point headwind on COGS alone, what are they relying on to offset such a massive shock?
That is the right question. And they're banking on two key things. One is internal efficiency. The other is the external competitive dynamics.
Okay, so internally, what are they doing?
They think supplier negotiations can offset some of it to get COGS closer to 30%. But the really fascinating part is they're seeing a genuine bright spot in labor efficiency. It's a real counterpoint to all this margin pain.
Tell me more about that labor success.
So labor as a percentage of sales was actually reduced to 32.5%. That's down from 32.9% year over year.
And I'm confident they can get more.
Highly confident. They're targeting a full 100 basis point improvement in labor leverage for the full fiscal year. And this isn't just cutting staff. It's driven by the reservation system, the new touch panels.
And what about the automation? I remember they were pushing robotic dishwashers.
They are. And this is a great little deep dive nugget. Those robotic dishwashers are on track for Q3 installation. They're targeting a retrofit in most of their 50 eligible existing restaurants by the end of the year. The full financial benefit might not hit until fiscal 27, but the operational efficiency is just profound.
And that confidence is why they didn't back down from their aggressive expansion plans. They reiterated all of their guidance.
Held the line completely, sticking to total sales of $330 to $334 million and still planning 16 new restaurant openings.
Which keeps them above a 20% unit growth rate.
Exactly. And they have great visibility, too. 14 of those units are already identified. The growth story is full steam ahead.
Okay, let's pivot to pricing power. Their 18% margin target depends on being able to raise prices without scaring customers away.
And this is probably the most counterintuitive, bullish data point in the whole call.
What did they do?
They implemented a 3.5% menu price increase on November 1st. And because of how they lap prior adjustments, the effective price increase for Q2 is actually expected to be about 4.5%.
Now, normally, a 3.5% price hike, especially with negative comps, would hurt traffic.
It would, but they saw the opposite.
Wait, really?
Yes. Here's the kicker. Management explicitly said traffic and mix improved in November and December after the price hike.
So they raise prices, and more people come. What does that say about the rest of the market?
It implies their competitors are getting hit even harder by tariffs, maybe 300 to 400 basis points for them, and are being forced to take even more aggressive price increases.
Which makes Kura the relative value option, even with their own price hike.
That's the thesis. Their unique, fun format lets them maintain traffic while everyone else is shedding it because they have to hike prices so much more.
And that plays right into their experiential marketing with the branded collaborations, the LTOs.
Precisely. They create that must-visit excitement. They had huge success with Demon Slayer and One Piece in Q1.
And what's coming up?
Management was very excited about Sanrio in February, followed by Jujutsu Kaisen in March and April.
And it's not just the brand, it's how they deliver it.
Right. For the current Kirby activation, they introduced custom-themed Mr. Fresh domes, the little shields on the belt, and even themed touch panels. It elevates the whole experience. You're paying for the event, not just the food.
So shifting back to the investor context, they're bullish on near-term sales. What are they guiding for Q2?
They are explicitly guiding for a positive comp in Q2. They see that momentum from late Q1 carrying through. Plus, they have easier comparisons. They believe their internal initiatives are generating real organic momentum.
We should probably touch on that shelf registration. That always makes investors nervous about dilution.
It does, but the CFO really downplayed it, called it good corporate housekeeping. And you have to remember, their balance sheet is very strong, $75 million in cash and investments and zero debt.
So it's opportunistic.
It's opportunistic. They're preparing for a potential opportunity, not signaling distress.
And macro environment seems to be helping them long term.
It's a terrible environment for their smaller competitors. Kura noted that the severity of tariffs is leading to accelerated closures among independent restaurants. That just clears the runway for Kura's own unit growth.
And there's a key date coming up for investors.
Absolutely. Everyone will be watching their ICR conference fireside chat on January 13th. Management will refresh their outlook then. It could be a major catalyst.
Okay, let's get to the segment where we discuss something a bit outrageous but plausible. And just to be clear, this is not financial advice. But given the high short interest here, over 26% of the float, and that confirmed positive comp guidance for Q2, you have a coiled spring situation.
You really do. The market is completely obsessed with the Q1 margin miss. But the unit growth is flawless, and traffic is accelerating. It's a perfect setup for a short-term volatility play ahead of that ICR conference.
The technical setup meets the operational catalyst. So what's the trade idea?
The trade would be to buy short-dated, out-of-the-money call options expiring right after that January 13th event.
An aggressive play.
Very aggressive. The thesis is simple. If management gets up there and successfully telegraphs that the November and December momentum is accelerating, that the pricing is sticking, traffic is positive,
and that they have a clear path to that 18% margin target.
Right. That confirmation could trigger a massive, reflexive short covering rally. You're betting the narrative shifts from the past margin miss to the future accelerating growth, causing a multi-day surge.
We've definitely unpacked the core dilemma, excellent top-line growth, aggressive expansion. But it's all being offset by these material tariff pressures. The entire story for 2026 really rests on their ability to deliver positive comps and hit that 18% RLOPM target.
What stands out to me isn't the problem, though. It's management's confidence in their solution. They are convinced their experiential model is actually growing traffic, even as they take price. That's a powerful advantage. So the question for you, the listener, is this. Can the Q2 turnaround they're guiding for be strong enough to convince a skeptical market? Or will investors wait until the recovery is fully printed before they buy back into the growth story? Something to think about as we head towards that critical update next week.